India has had a fabulous year till now, 30% YTD gains. The question mark that remains with all that's happening globally, can the next 12 months, this somewhat to next somewhat, be the big breakout year that everybody's been talking about? Welcome to that very show, A Breakout Year on ET Now, a Diwali special. And we have a very special guest to talk about the possibilities and the limitations thereof. Ridham Desai, needs no introduction, joins us right now on the show. Ridham, thanks so much for joining in. You know, the last 2 weeks have been dominated by global chatter. What's happening globally and can that impact India, so on and so forth. So let's start off this show on that premise. When we talk about the next 12 months, is the globe aligned to let India have that breakout year?
So I think the world represents a big risk factor, bigger than what I think we acknowledge. Let's evaluate it for a moment in terms of fundamentals. So you have 4 major blocks which are facing deflation threat. I would say 3 certainly facing deflation threat and 1 in disinflation. Japan, Europe, China, and the US, which is in disinflation, not exactly deflation. 3 out of these 4 also are facing demographic challenges: China, Japan, and Europe. And all 4 of them are heavily loaded with debt. So you got this 3D problem. And I know our Prime Minister mentioned another version of the 3D recently at Madison Square Garden, but the world has got this 3D problem, which is debt, aging population, demographics, and a threat of deflation. So it's not a pretty situation for risk assets. And time and again, I think you will face this uncertainty in world equity markets as they grapple with the consequences of this. The consequences will only play out in the medium term. So it's not like the world is about to collapse in the next 12 months. It's not like that. But over the medium term, there is a big adjustment that could happen because the world has to adjust to this large level of debt and a deflation threat, which basically represents excess capacity. So India will keep facing that headwind. And I think it's underestimated. Mainly because I think India's own factors are very strongly positioned right now. So India has been very resilient, even through this turmoil of the past few weeks. Very resilient, both in terms of actual performance, but more significantly in terms of volatility. So I don't really worry so much about the performance bit. You know, you could lose a bit of performance, but the volatility thing is what worries me more, which is that the markets are refusing to get more volatile. And that, I think, leaves us exposed to greater volatility in the future. So the next year, it seems quite guaranteed that we'll have more volatility than what we've had in the last 12 months. Performance we may still retain, but it will come with a bit more volatility. It will not be so simple and straightforward as it has been in the last 12 months.
But could we challenge 7,000? Is the volatility also going to be with a very, very wide range, or are we going to play around like we have so far?
So 10% is what 7,000 is, right? So 10% is par for the course. I don't think 10% should be a big issue.
I like the way you're shrugging your shoulders, saying 10% is...
Yeah, but 10% okay. After a 30% move is a third of the move. So I don't think that should be a big deal. You could easily lose 10% at any point in time if there is a big scare in the world. You know, let's discuss a factor that's helping India's performance, say oil. So oil is... The relationship that Indian equity markets have with oil is not linear, okay? It is certainly not linear, which is that it is not inversely correlated in a linear fashion. So oil goes down, markets go up. The relationship is concave, which is up to a certain point, India actually is positively affected, so markets do well. And then a tipping point comes when actually a further fall in oil prices brings down the markets, because that tipping point represents big risk aversion. And it causes the markets to fall.
So are we close to that tipping point?
No, I don't think so. I don't think so. You need a much more dramatic sell-off in oil. But it could come, and that could bring a 10% correction very easily into equities. To me, it's actually still a buying opportunity because I'm not looking at this from a 12-month perspective. I think, like a lot of other people also think that way, is that we are in a 5-year bull market, and therefore all these corrections are likely to represent buying opportunities, and the only risk to that 5-year bull market is that we end up with a government that does nothing, and that also seems less likely, because it seems quite firm on the government's mind that they want to change things. So India has the opposite situation, which is it has got very little debt, It has very favorable demographics, and it certainly does not have deflation. So it is sitting in the opposite camp. Most long-term investors that I talk to are of the view that there are very few places on the planet where you could put money to work in the equity market, and India certainly is one of them. And in fact, a lot of people also think that our debt market is also very attractive, and I would tend to agree with it. The duration in India is coming quite cheap. So India does represent a kind of a separated opportunity in what is otherwise a challenged world place. But the risk of the world will always come to the fore at various points in time, especially since you're asking from a 12-month perspective and not 36-month perspective.
So I just want to talk about the 3D risk that you pointed out, and interesting prognosis at that, and which we've seen play out already at a time when US year to date has already turned negative. We are standing tall above 24% or so. Do you not think that the 3D money would actually then flow into India, because the money has got to go somewhere? So could India not be a beneficiary?
Yeah, see, there's only that much that India can take.
Right.
It's only $1.5 trillion market cap. So we can't take all that money that could leave other places. I don't like the money logic. Money is a trailing indicator. It follows returns. It doesn't lead returns. So I know you discuss flows all the time, but flows are lagging actually. They follow returns.
Right.
In fact, a lot of things follow returns. Equity markets lead almost everything. They lead strategist opinion, they lead economist opinion, they lead analyst opinions, they lead economic growth, they lead earnings growth. A lot of things actually follow equity returns because they represent the cost of risk capital, and as the risk capital cost drops, it basically creates a better growth environment. So flows, I don't like to argue it in that fashion because I think they lag, but as such, I don't think India has the capacity to absorb that type of flow. But it will get, and it has in fact over the last 5 years, got more than its fair share.
How high is the risk of a sell-off in commodity-linked economies? It's probably already happening in Brazil and Australia to that extent. Can it continue further, and can it have an impact on India?
It can. So I think the world is reflecting on the possibility that growth will disappoint in the next 12 months. So that's what asset markets, commodity markets are trying to tell us, that it's not so hunky-dory, that inflation will be a challenge and that growth will be a challenge. And if this morphs into a global sell-off of a bigger proportion than what we have seen thus far, it will rub off on India at some point in time. India can't be the last man standing. And it may correct as a consequence of such a big sell-off.
But the likelihood of that happening is less. You believe that the converse has more probability?
I don't know what the probability of such things is, but I think it's a risk that we should keep in mind. And it is a risk that is currently underestimated, which is a lot of people are focused on India's domestic events and are underestimating the risk that we may actually get from global. So, let me put this in another way. From a medium-term perspective, a China slowdown and therefore lower commodity prices is godsend for us. It's great news for us. Yes. India's terms of trade are shifting very positively. Okay, and that's because for the first time in 5-7 years, we are on the better side of the commodity trade. So without doing much, we're already seeing tailwind into our economy, even without actually undertaking major reforms. That tailwind on the medium term basis will be great news for India. In the short run, it could have different implications for equity markets. So it's good for the economy, but the impact on the equity markets is driven by short term sentiment, which could move in extreme zone very quickly.
The currency is beginning to weaken again. Where does that lie in the pie chart?
So again, that's a relative thing, which is India has actually outperformed most non-dollar currencies. So it's weakening against the US dollar, which is what we see all the time. I think that's good news. I would think that, from a fundamental perspective, an overvalued currency is not good news for the economy. So I think the central bank will be very happy to see a weakening currency. It will help economic growth in India. So one of the problems India had last summer before the sell-off, going into the Fed taper event, of course we had many problems. One of the problems that kind of accelerated India's problems was the fact that the currency was overvalued. that it was not representing the cumulative inflation differential that India had run up against its trading partners, especially the US. That risk, I think, kind of reduces if the currency is depreciating. So I think that's actually good news. I wouldn't fret about the currency losing ground.
We probably got one more stable hand as well. I think Euromoney just awarded Raghuram Rajan as the best central banker as well. So probably not just Modi, but a lot of other hands as well. But stay on Ridham. So much more to speak to you about. We need to slip into a very quick break. Come back and talk about the local factors that could also have implications on how India does over the next 12 months. Stay tuned. Back with the breakout year and back with conversation with Ridham Desai. So Ridham, we've discussed the globe and where India stands, more or less. Now, domestically, a lot of things are going to happen. Probably we will see a lot more reforms taking place than what we've seen in the past 4 months of the new government, or probably the last 5 years of the country as well. How big a play or how big an influence could those have on how the country does, and of course, how do the markets do?
So firstly,
what would you watch out for the most as well in that process?
So firstly, I'll say that since the end of May, we've actually seen substantial action from the government. And
much unlike popular belief.
Yeah, I continuously debate this with investors globally, because a lot of investors get this feeling and voice it that India has not done much, and that this is all going to disappoint. So what we started doing actually a couple of months ago was actually start listing the stuff that has happened.
Okay.
And that now runs into 9 pages. Okay. So 9 pages of work in 5 months. Okay. So it's a lot of work that has happened in Delhi. Don't underestimate even for a moment. The results of those changes will be felt in the course of the next 12 months.
Yeah,
and the sense I get is that there's a lot more that's coming. So this is just the beginning.
Okay.
Sorry, you want...
I was just asking about that they have not been headline-grabbing reforms.
Exactly.
Yeah.
But India doesn't need headline-grabbing reforms where it is at this point of the cycle.
Okay.
What it needs is subtle shifts. And those have happened. What we needed, if you look at what happened in the last cycle, and I'll quickly recap the 3 or 4 things that went wrong. We had a distorted fiscal policy, overreaching wage program, negative real rates, excess investments, and indecision by the government. I will not discuss the global factors here. These were the 4 or 5 things that were ailing us. If you look at what the government has done, the indecision has stopped. Decision making is happening. And I've checked with a lot of entrepreneurs, I've checked with other data that's coming, and there's independent data out there. There's been massive activity on projects that were not working, say, 6 months ago.
Sure.
So we've seen closures of projects, we've seen project work commence. We've not seen new investments, and I don't think new investments are coming in a hurry, and I'll come back to that in a moment. We've seen a big contraction in the fiscal deficit. In fact, in July, when the finance minister presented his fiscal deficit target, we were a bit disappointed because we thought it was too aggressive. And we thought it was not necessary to be so aggressive.
Sure.
That a 4.5, 4.6 number would have done.
Yes.
Because the starting point in March was 5. Today we are sub 4.2. And the chance is that for the first time in a few years, we will beat our estimate.
Right.
So that's done.
Yes.
Third is, of course, not the government's doing, but the RBI, which is RBI has steadfastly since January had positive real rates. And there is no communication from the RBI which suggests that that's going to change, thankfully. So they are pegging down inflation expectations. On other matters with respect to inflation, the government has done a stupendous job. For example, all this grain stock has been coming into the market. When the MSP price increase happened, it was the lowest price increase in 11 years. So they have managed to also contain food inflation. So no wonder you're seeing it in the prints now.
True.
So you see the amount of work that's happening here. So those main problems that were causing the trouble in India are now actually unwinding. Then you talk about excess investments. The government has told NTPC, don't do new projects, buy out existing ones. NTPC put a tender out, 39 people offered their projects to NTPC. We were suggesting in April, when we were writing down what the next government needs to do in terms of policy, and one of the things we were suggesting is you need asset reconstruction company. The government has gone one step ahead and not done the conventional ARC, which is usually a financing entity, but put an operating company as an ARC. So you get financing and you get a recovery in operations, so it's much faster turnaround. Likewise, the NHAI is taking over 6 road projects. So for a moment, let's not underestimate the amount of work that has happened in the last 4 months. And most of it, this is happening in the right direction, which is lifting productivity of the economy. In the next 18 months, we don't need new investments. We just need to make our existing stock of investments more productive, and growth will go back to 6.5%. Then for it to go above 6.5%, work has to be done.
Sure.
The government has an 18-month window. So what has it done there? The GST law is almost ready. Okay, the draft bill is likely to get presented in the parliament. We've been sitting on that draft bill for 8 years now. It's about to go to the parliament. There is an agreement that has happened between the states, or it's an ongoing thing, but it seems so challenging 5 months ago, and now it seems like almost everybody is agreeing to what the GST bill should look like. So I think even those reforms are on the anvil. Whether you look at land acquisition or labor reforms in Rajasthan, similarly in Madhya Pradesh, and I think a lot of other states will follow up. These are state level changes that are required. Go and check with the project management group, PMG, the one that was set up by the previous government, and see the amount of work that has happened in the last 4 months. They have transferred their knowledge as of my last conversation with them, which was a few weeks ago, to 16 other states. Because the gripe was that, well, 50% of the projects are stuck at the state level.
Sure.
Now that also has started changing. So I think a lot of the medium term stuff is also happening, and probably more will happen over the course of the next few months. So I'm not at all worried about the action at the government level. I think that is actually following the best possible path as of now.
I want to get back to equities. Like you say, the road ahead is going to be a volatile one. We've seen a fair amount of sectoral churn now happen off late, ever since we started receding from 8,200 thereabouts. What happens now? Does the market in the next 1 year become a stock picker's market? Because clearly you get that feeling that those blanket sector calls are not going to work at all.
That's the trailing conclusion, right? The market has been reticent. It is still waiting for more thorough signals to pick up cyclical sectors. So for a while we saw cyclical sectors or high beta stuff do well, and now that's given up. It's a clear sign that the market is not convinced. So that's good news. I would not like to buy a market that's convinced, because then that's a fully priced market. So my judgment is that the market is not fully convinced that we are in a 5-year bull market. The day it is convinced, then there will not be much juice left. So I think there's certainly some change that could happen, but ultimately equities pay for cash flows, and businesses need to generate cash flows. Whether cyclical or defensive is only the description we give, right? The business needs to generate cash flows, and those which generate cash flows will get rewarded. So I do see some of these so-called cyclical sectors do better in the next 12 months. But some of the so-called defensive sectors, if they continue to do well in terms of cash flow generation, I mean, like say technology, which I think will continue to do well, because US capex is looking okay. I don't see any reason why you shouldn't, be buying stocks in that sector.
And pharmaceutical is not looking expensive to you at all.
I think it's more selective. But you asked a very pertinent question about whether this is a stock picking environment or a macro trade. So I think it's actually a big macro trade.
Really?
Yeah. So if you look at the correlation of returns across stocks, they are very low. Okay, which means that the market is behaving very idiosyncratically. So it's picking stocks. That's what it's doing right now. And history shows me that this is a mean reverting variable, and this is where we are. So it's the stock picking characteristics. The stock picking characteristics of the market are as deep as they could be. So the likelihood is that this mean reverts. So you will get a big macro trade. I can't time this. It could take 3 months, it could take 6 months, it could take 9 months, but a big macro trade is coming.
But the next 1 year?
Possible. But it's certainly coming over the next 2 years, I would say.
So what would come first? Sorry, 7,000 or back to 8,200?
If I knew the answer. No,
Give it a shot.
No, I think, people, my approach to this philosophically is that you always keep some powder dry, because it's hard to tell what the next level is, and it's quite possible that you get a 7,000 print and you have some powder dry which you can then use. So you never exhaust all your ammunition at any point in time in any market. It's okay. And somebody had asked me this question in my office but then what's plan B, right? Because somebody, plan B, if you are sitting on 10, 15, 20% cash, well, plan B, somebody else will get richer.
Okay.
So I think it's okay. It's okay to have that. It's not it's psychologically sometimes it can be very challenging. If a market moves 10% and you're sitting on 15% cash, it's 1.5% return that you lose. It's not a big loss for the optionality that you retain to buy a moment of panic. And the moment of panic is almost there. I'll give you examples from the previous bull market. May 04, May 06, early 07. Every 18 months you get a moment of panic, and these panics are not like 5-10%. Markets go down 25%. So it makes a lot of sense to sit on a little bit of cash and retain that optionality to buy the panic.
So what do you buy when we get back to 7,000 is the question.
Well, that's again a function of what sells off. But I have always endured an allergy to beta, so I don't like beta. Fundamentally, high beta means high hurdle rate, so harder to make returns on it. So I like to buy businesses that have good predictable cash flows that are trading at reasonable valuations. They don't have to be terribly cheap. In fact, again, I think the relationship between PE and returns is also a smile, which is that inverted smile, which is low PE stocks are dangerous to hold and high PE stocks are equally dangerous. So the sweet spot for PE is actually somewhere in the middle. Low PE stocks,
balancing the seesaw.
yeah, low PE stocks in most parts, not all of them. So here, this is not a sweeping statement, but 80% of low PE stocks are low PE because there's a problem.
Right.
Okay, the market knows about it, so it's communicating that to you, and you have to be very sure that that problem is going to turn. For that, you require tremendous insight. Okay, and therefore the risk is you go wrong. High PE stocks have a similar type of issue. The middle is where the sweet spot is. So you don't need to chase extreme P's as your investment style.
So your broad call is that cyclicals could do well. I want to ask you about the new age sectors because there's a lot that's happening there. I mean, there is smack in IT space. People are talking about e-commerce and how logistics could gain, so on and so forth. There are multiple new sectors that are there which don't have a proper history. Assuming that the market does go up, what to your mind stands out from that pocket? Because there's a plethora of options available there.
Yeah, so I think the sectors will do well, in my view,
right,
as India grows. Technology will grow, usage of technology will grow. But that doesn't mean that investors make money in the stocks.
Okay.
Because individual businesses may not necessarily survive what could be a tumultuous time and a lot of churn. See, India, let's take the internet space for example, and for a moment, just for argument purposes, India's internet space is different from China. In that China has not had foreign competition, we've had foreign competition from day one.
Right, sure.
So to my mind, Indian companies, the ones that survive, will be far more robust than the Chinese companies. And I'm making a very generic broad point, it's not a specific company. The problem for me is to figure out which ones will survive.
Yeah, so
that's
what
very
does an
hard.
investor do, Ridham, is the question. I mean, how does he identify what to look at, what not?
In a portfolio, you should always have some exposure.
No, but within the current scheme of things, I mean, what looks good from the new age sectors? Is it logistics because of what e-commerce will do, or is it smack because of the promise that it holds globally? What looks nice?
I think again, these are very granular questions actually. And if I say logistics look good, then somebody will have a stock in his mind. So, oh, that stock looks good. So that will be a wrong way to conclude.
Okay.
I think you individually assess these businesses. In my view, some of them are levered to GDP growth, which is not necessarily the way I like to play a portfolio.
Okay.
I like to buy stocks which are not necessarily dependent on GDP growth, just in case you're wrong. But some part of your portfolio can have leverage to GDP growth, like logistics, for example. The internet space, I think, will grow, and therefore, if you can buy things which are linked to it, you should do well over a 3 to 5 year period.
Final question then, at least from my end. So, in a nutshell, for the index, the next 12 months hold more probability of outperforming. There is a chance of a breakout year as opposed to a breakdown year.
See, I think India has got better dynamics than most of its peer group. Terms of trade are improving. The reform momentum is picking up, and the economy is turning cyclically. So, arguably, I think India should do well.
Okay, so one quick rapid fire round before we wrap up. I don't have a coffee hamper for you, but very quickly then.
You should send me one after this.
For sure, done deal. What would come first, 7,000 or 8,000?
See, I think you should be prepared.
It's a rapid fire. It can't be so long. Snappy.
8,000.
8,000. Okay. Your top long when it comes to India?
Private banks.
The key positive going for India?
Disinflation.
Key negative?
Global.
Any short?
Avoid utilities.
And the coffee hamper is going to reach you soon.
So it will reach you in your office from ET now. But great. Ridham Desai, thank you so much.
And here's wishing you a very happy Diwali from all
Same
of
here
us.
to all your viewers and to you, and have a wonderful year ahead.
Ridham Desai, thank you so much for joining us on this leg of A Breakout Year, Diwali special. And hope you guys enjoyed watching the show as much as me and Ayesha enjoyed doing it. Thanks so much for watching.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.